I would like to provide you with a little bit of an introduction to basically onboard everybody here, but primarily I would then in 5 to 6 minutes show you a real live Google Sheets document to really make everybody understand what happened in the last days or hours with regard to Celsius, the topic around collateralization and so on, because in my mind everybody talks about collateralization, but very often people have difficulties understanding this because they have never really worked on such Excel sheets showing the numbers behind. I will do this later on. I prepared it this morning, but before this, let's jump into the topic to basically onboard everybody to what's happening in the DeFi scene, and I will be very, very brief here. So thanks for the presentation. We have founded the Blockchain Center at the Frankfurt School. The Frankfurt School is a smaller university in Germany focusing on finance, and we are, as an institute, privately funded by the companies you can see here, and we are doing all kinds of things in the area of knowledge exchange, education, workshops, study programs, and so on and so forth. So to very briefly jump through the current ecosystem where we are right now, I think it's very interesting to note that blockchain is now a topic which is existing in multiple domains. We have the topic around digital securities on blockchain systems. We have the topic called Euro on blockchain. You could also call this partly, at least, the CBDC topic with the central banks. Then you have the most dynamic topic out there, that's decentral crypto assets in all kinds of forms, from Bitcoin to DeFi and NFT. Then in the future, I think we have the topic of tokenization of CO2 on blockchain and also identity management. This will come in a few years. And I think it's also interesting to note that all this stuff is being regulated these days. For example, decentral crypto assets have already been regulated in Germany, providing a very good framework for companies to operate in. Then we had the Digital Securities Act last year starting to regulate the digital securities domain. We had the Fund Location Act, and we will next year, end of 2023, probably have the MiCA regulation coming to us, which has started with good goals. But now, as we see how the regulation is unfolding, and when we now see each specific rules, there are some very, very big issues there when it comes to promoting innovation or closing it down, right? We will see this in the discussion of the next months, because now that the rules are clear, we can now see that MiCA regulation might be really a threat towards corporate innovation, not individual innovation, but to corporate innovation in the European Union. But that's not the topic of our presentation. So how did we come here over time? I think we have to analyze the crypto ecosystem in various clusters, right? It's like industries in the traditional economy, where we have multiple industries going from chemicals to automotive to mobility and all kinds of things. We have the same in the crypto ecosystem. There is the domain around storage of value. That's Bitcoin and nothing else, right? That's basically an industry with one player. Then we have the smart contract platforms. That's Ethereum, Solana, Polkadot. That's the underlying platforms of DeFi that started roughly in 2015. And that's basically an industry or a cluster where there is some competition here. You see Ethereum is the #1 competitor, and you see other protocols trying to gain market share from this company. Based on the smart contract platforms, DeFi with all kinds of applications emerged. They are now not just emerging as applications, but they are also running on multiple platforms. Then we have quite recently the NFT domain unfolding with all the hype and all the craze and also all the falling down. And at some point of time, people will find out where NFTs really are beneficial. I don't think that this will be digital art. And quite recently, we also now saw first steps of the metaverse. This indication here is not perfectly fine because we have Decentraland already existing years ago, but the narrative of the metaverse just started last year. And then, of course, I think it's interesting to see what will be next. Maybe it's decentralized identities. We don't know yet. But you see here, it's basically a growing ecosystem because all these stacks are coming on top of each other, right? all this started with Bitcoin as a decentral network. We have more than 15,000 nodes here. We have also Ethereum with more than 6,000 nodes. We have Solana and Polkadot and all kinds of other networks, which are called decentral protocols. Decentral means that they are running in an unstoppable way. That's at least true for Ethereum being unstoppable, but it's to a lesser degree also true for other systems. That's, for example, where I'm skeptical about Solana, because Solana has stopped multiply. That's basically one indication that it's not a perfectly designed decentral network. Bitcoin should be defined as the worldwide network. That's the same like Ethereum being a worldwide network. So in my mind, it doesn't make sense to define Ethereum as a server or as a software. Rather, it's the network of thousands of computing nodes switched together. And in case we are now going back for a couple of years, then a couple of years ago, we had Hyperledger and R3. They wanted to also form permissioned networks as enterprise blockchain systems, exactly with the same applications. Think of the US dollar running on an R3 network, think of the euro running on an Hyperledger network and so on, but all this actually has failed, right, as we now know it today. So the dynamic is very clearly going on the left side domain with decentral protocols. It's not so much going on in the enterprise world with industrial corporations and so on, because these systems here on the right-hand side, they have not promised, they did not hold what they have promised, right? You can see this by the numbers. We have a daily transaction volume of 80 billion day by day on the left-hand side, and we just have a couple of advanced prototypes. After years of works of dozens of corporations, there is not much more to see than a couple of advanced prototypes. That's unfortunately the truth, but we have to deal with it. And the good thing is that in case you read this slide here correctly, then I think career-wise, investment-wise, from a personal feeling and so on and so forth, it makes much more sense to deal with the topic on the left-hand side, which are decentral networks in all its forms, from DeFi to NFT and so on. So now let's jump in the topic around decentralized finance. I think this chart is well known. Please look at the right end of the slide. You see here that this slide ends in October 2021. At that point of time, it looked all very nicely, and everybody thought, including myself, that this chart will go on like this forever, right? Going towards billions of total value locked based on these applications, right? Please look at the right-hand side. That's where you see the domains. I think DeFi, the key DeFi applications are trading, lending, asset management, derivatives, and insurance. I would also add another one, which is stablecoins with the MakerDAO, with the DAI protocol, which is inevitably important. Same is true for USDT and USDC, which are very important building blocks required here. And the interesting point is the following. Imagine a country like Germany, where you have hundreds of banks operating the capital market for all kinds of investors and issuers and so on and so forth. That's just Germany. So on a worldwide level, it must be thousands of banks, right? In case you think the DeFi promise to an end, then you have a couple of layer one solutions. You have one super application for trading, one super application for lending. You know, that's the ideal. You know, this ideal will not happen, but the ideal would be you have one application for trading, one protocol for lending, one protocol for derivatives, and so on, for the entire worldwide capital market, right? And that's basically a very far-fetched promise, but I think it's an interesting image to have in mind, because you can easily argue that the worldwide capital market could be operated by a bunch of layer one solutions, on top of which a bunch of key domains, key applications, key protocols are running and basically operating the worldwide capital market. You know, that's a far-fetched vision, I know, but you need to put it aside with today's infrastructure of thousands of banks who are doing basically exactly the same. That's where the narrative of disintermediation comes from. Yeah, I showed you the chart before. I think we know what happened in the last couple of days and also weeks. Basically the chart looks now as follows. The total value dropped significantly from more than 100 billion to 41 billion this morning. But I think it's also interesting to have in mind that the technology is basically not changing in its fundamental way. Just the over-exaggeration basically is going away. Still, that's basically the key protocols which are out there. And for me personally, it's interesting to see MakerDAO still ranking on #1. This is something I would not have expected a couple of years ago, because a couple of years ago, MakerDAO wasn't the most sexiest protocol out there. People have left MakerDAO, went elsewhere, doing new things, but apparently they have now become quite decentralized. They are at this point of time the only large-scale decentralized stablecoin out there, and so on and so forth. But you see here that basically also quite a concentration of protocols already happens right now. The interesting point is also that most of the chains being used is at this point of time still Ethereum. I think that this will be getting more complex in the future, but I also believe that Ethereum will be there for quite a while. In case you look at a similar curve here, which is the total market capitalization of all crypto assets, then you see that this happened, and it really doesn't feel very good. I think we all noticed from the last couple of days with the major drawdown starting in the beginning of May. But what we should not forget here is that these are assets coming from 0 going to 3 trillion and now being plus minus 1 trillion. So in case you are dealing with assets that's going through all kinds of orders of magnitudes, then it's better, and to be honest also more healthier, to look at the y-axis in case you are using the log scale here. Then it looks like this, and here you can very clearly see that basically the trend towards adoption is still okay. It would be very, very, very risky and bad in case this drops to say 100 billion in market cap instead of 1 trillion. But to be honest, this is not just unlikely. I would at this point of time say that it's basically not possible. So everything is, in my mind, okay. But of course, it's a tough time, and I think we need to wait a couple of weeks, maybe months, and then it will be a little bit healthier. Before I jump into this, because time is so scarce, I would now like to share you this little exercise on understanding what collateralization is. Let me now share another screen. And you please tell me whether you see the slide right now. Can you see it?
Yes, we see it.
Okay, perfect. So what I would like to make here is, because this major drawdown, probably because of Celsius, happened in the last couple of days, I would like to explain to you what happens, because primarily also with people like Michael Saylor and other ones, I think it's important to understand how this collateralization stuff works exactly. And I think it's also one of the key domains out there where DeFi did work in the past and where it will continue to work. So it makes so much sense to understand how collateralization works. So typically, I write this down here, typically you would say a good strategy in the current ecosystem, in the current state of our world, is long crypto, long Bitcoin, because then you can deal with Bitcoin and you find a way to work around inflation. But in case you are thinking this strategy to an end, like Michael Saylor, for example, and other people, then you would not just go long crypto and Bitcoin, but you would also short US dollar and euro, because then this strategy basically is thought to an absolute end, right? You can dispute this, but that's basically the strategy people have. And this basically is the strategy which can then be executed through collateralization. So how does it work? So imagine we are having this kind of crypto portfolio. We have 1 Bitcoin. We purchased this back in April, back in March, when the price was 40,000, maybe a little bit earlier. We have also purchased 10 Ether, so maybe this portfolio was in February or in January, I don't know exactly. So what is now the key point here is this loan to value metric, which indicates that this is 40%. This is something you can contractually agree upon, for example, with the bank, or alternative to the bank, that's where it gets DeFi. You are writing such metrics in the smart contract of the trading protocol. So the weighted value then decreases from 40,000 to 16,000. You then have potentially currency conversions. They are also affecting this entire image because inflation rate is going on, and also companies are valued differently, but we continue now computing everything in euro. So the entire asset portfolio, as I have said, is 40,000, right? 1 Bitcoin, 10 Ether, that's 40,000. Then you have basically a weighted asset value of 40% of 32,000. So this means that you can get up to 30,000 euro loan because you are pledging these crypto assets as a collateral, right? So for example, here with a bank or with the protocol, there might be a limit of 50,000 of a credit loan. And for example, in the beginning, I do not have any loan. I'm basically not leveraged at all. But now I start to really do this strategy of long crypto, long Bitcoin, and shorting euro, shorting cash. So I take basically a loan. What do I do with this loan? For example, I can purchase real estate, I can do daily consumption, and I can, of course, purchase more crypto with this, right? That's what people have done, leading to a leverage position, which now basically have deflated in the last couple of days and weeks. So what happens now is that's basically the limit of my loan I can make maximum get, because that's basically the maximum collateral capacity I have. I now took 20,000 euro of loan. So the security margin here is more than 100%. So that's basically healthy because I only took 20,000 loan, but the capacity is 32,000, right? That's measured here with 125%. So what happens now in the last couple of days when the prices come down? We now set, for example, Bitcoin to 30,000 and Ethereum to 3,000. So you see here assets going down, the portfolio value goes down, the weighted asset, basically the capacity for my loans is also decreasing, but you see here the capacity is still above the current loan I took, but the security margin now decreased to 111%. So what happens now in case the price drops further, as it happened in the last 24 hours? So now it gets critical because the capacity of my collateral is only 16 because the price has dropped, but my loan, of course, is still standing there with 20,000. So now the security margin has dropped to 83%. Now it's getting dangerous, right? What happens if the price of Ethereum drops further? Then you see what happens. The security margin is now going to 55% and so on, because as you can see here, the loan is higher than the capacity of my collateral. So in case this is now a bank, let's make this again. In case this is now a bank, what options do I have? And that's basically exactly what happens with Celsius. This is partly what's happening with Michael Saylor, and it's happening with many individual investors on the entire world. What happens? Ether, you can bring more assets because this way you can re-collateralize the loan, that basically with the share of 40% above here, you could basically bring another Bitcoin in case you have one. This only works, of course, when you have Bitcoin. So you can re-collateralize the loan to 24,000, and this number is bigger than this one. Alternatively, you are simply purchasing back part of the loan. This is, for example, what Celsius did not do. And of course, the last part would be selling collateral. That's, for example, what has been done partly. And in case you're doing this, you're selling collateral, then you can pay back part of the loan, but also you're driving down the price of Bitcoin for all other market participants, especially when this is done by many people, because of course you're creating an excess supply. And that's my personal opinion why the Bitcoin price went down so dramatically. And here you see that basically what is a soft margin call? A hard margin call would be that the bank or the smart contract, without any further notice, could sell the Bitcoins of you, because only this way it can cover the loan which is still there, right? And with banking, you typically have a soft margin call. That means the bank is calling you or send you an email or a message or whatever saying, okay, now in case this figure is going to 75%, so the capacity of the collateral basically is shrinking too much, then the bank is calling you, is sending you an email or whatever it does, and ask you to basically do one of these tactics to recollateralize the loan. So in case the Ethereum price now falls further to 1,000, for example, then you see here the capacity of the collateral decreased, the loan is still there. Again, you have to bring much more Bitcoins in case you have them, or you pay back part of the loan, or you sell collateral, which would also be possible. Celsius partly did this, but also as far as I'm informed, they also did this. And now you see that the security margin has dropped below 75%. Yeah. So basically it's below here, and therefore, because the security margin has been hit, so 55 is lower than 75, that's basically when the soft margin call is then executed. So now the bank would call me, now I get an email, now I get a notification and so on. And the bank is now doing standard procedures, basically announcing me that I have 5 to 10 days remaining to do one of these tactics. But still, look at this. That's very important now. The asset value is still 30,000, right? The asset value is still 30,000. That means even though the asset value is still 30,000, I could cover my loan entirely in case I wish, right? So the substance is still there, the value is still there, but the margin call is still executed because of the volatility. Volatility is reflected in these 40,000, but I could still pay all the loan in case I would immediately sell all the crypto assets and basically repay the loan, because this number is higher than this number. And what happens if the Bitcoin price drops further? Then the hard margin call is happening. I have 4.7% left here. So in case Ethereum drops further, then I'm slowly approaching these 50% here. You look at this number. And in case the number is decreasing so far that the security margin is dropping below 50%, that's now here indicated by the minus, then now the bank would contractually be allowed to sell my Bitcoin, throw it on the market, decrease the price further such that the bank is able to repay its loan. And the interesting point I would like to close with now is that in my personal opinion, you have two ways for the future to operate systems that work like this. Either you do it with a bank, the bank is doing this on an individual basis, but it must be a fully regulated bank, or alternatively, you do it with smart contracts, because then the system automatically is doing this technically, right? But what Celsius is, it's basically some kind of partly regulated company. It's not a full-fledged bank, such that it doesn't have adequate risk metrics and portfolio controls in place, such that this happened what we just have seen. So Celsius basically is a bad compromise by selling a story which should be decentral, but at the end of the day, it is central, but at the same time, it's not fully regulated, because regulation could avoid such situations, right? So Celsius is basically a bad compromise between the left pole and the right pole. In my mind, good solutions would be fully regulation by a bank, as we know it from a couple of years ago and the last time, or alternatively with the more modern approach of putting this fully on-chain and removing the bank entirely. But this would then also lead you to the position that you have to fully do all actions yourself. You have to do self-custody yourself. You have to care about your assets yourself, and so on and so forth. So this extreme way of doing this technically with DeFi in a self-custody manner would also mean that an intermediary like Celsius is not required and must not be there. So I hope you get this point. Either you do it fully self-custody, peer-to-peer, yourself with the technology in place, or you do it with a fully regulated bank. But options in between are very difficult, as we have seen it with Celsius. Yeah, I think that's what I wanted to show you. I think given the urgency of this topic, hopefully make you understand what happened here. I think this Excel sheet is very nice, playing around with the numbers. I think much more people should do it.